Okay, here we are once again. Today, the Great Depression and the decade of the 1930s. The Depression spanned the 30s, so this is our look at the entire decade. This economic downturn was the biggest, greatest in our entire history. Let's hope it remains that way. But nothing has approached it ever since. It's hard, actually, because of that, for me to convey to students the severity of this economic crisis, because none of us in our own lived experience have ever gone through something so serious, along these lines. So I'd like to begin with just a couple of ways to help to personalize this. It's actually easier, for instance, for me to get across World War II to students, which is our next unit. Explaining explosions and large, gory battles, for some reason, maybe because of there's more movies about them, is easier for students to grapple with and at least understand than the Great Depression. Um, One of the ways I try to personalize this is, instead of dramatic battles and battlefields, it's like a pit of hunger in someone's stomach for like month after month, year after year, worries about how to pay the bills, how to feed the kids who are becoming more and more emaciated as the months go by. So it's just sort of this long, dull, drawn out, humdrum, worrisome, anxious, depressed life that went on for millions of people for a full decade. Uh, Something else I think that helps to personalize this as well. If you ever have known anyone that went through the Depression, even as a child, they're unfortunately not around as much anymore as they used to be. But my dearly departed grandmother, used to tell me all kinds of stories about growing up in the Great Depression. And when you talk to people like that, or read something written by someone then or now, or in the past or now, you'll find that they have not only distinct memories about the Depression, not everything, but certain things, but they tend to have the Depression imprinted itself on their minds and on their way of life so heavily that it ingrained habits into them that they kept even after they didn't need them any longer. So, and I've had lots of students raise their hands, and when I say this, and have stories of their own that are very similar. So, if you have, then you will understand. But my grandmother, for instance, used to make these wonderful homemade preserves, but it took her hours and days to do on it. And so I'd say to her, Grandma, I mean, these things are really good, but you spend so much time and work. Why don't you sometimes just go to the store and, buy some? And it's true that hers were better than the stores, but I still couldn't quite understand why she never really answered me, but I never could quite get it. But finally, after talking to her time after time about that and other things, I finally realized that that was a habit that she and her family acquired because they didn't have any money. They didn't have money to buy things, so they made as many things as they could at home because they had to, and that habit stuck with her ever since. You hear stories about people who lost all their money because their bank went out of business, and from that point forward buried all their money in the backyard, or put it under their mattress, and never trusted banks again, like 30, 40 years later, and be the rest of their lives, even though they didn't need to any longer, or at least it didn't appear they needed to, they still did. So the Great Depression seared its way into people's consciousness in some ways that never ever left them. So this is, I think, a good way to start on the Depression. We're going to proceed sort of in this following framework. First, we'll look at some interpretations of the Great Depression, seeing how historians, even to this day, hotly contest each other's views on the Depression, partly because so much of the Depression and government response to the Depression is still in play, up until the present. Second, we'll look at the economics of the Depression, the stock market crash of 1929, and the two presidencies the Hoover administration, and Franklin Roosevelt and his New Deal. And so third, we look then at that one administration after another. Fourth, obstacles to the New Deal, which included a number of individual figures. It included institutions like corporate America and the United States Supreme Court. So we'll tackle that in due course. And then finally, we'll round it out at a look at what average Americans did during the Great Depression. This is a way for us to, again, personalize the Depression. Much of the way the Depression gets taught, written about in history books, comes from sort of the top down. And in the last segment here, by focusing on average Americans, we'll see the Depression not from the perch of Franklin Delano Roosevelt, the president, or of the Supreme Court justices, but from average Americans struggling to make ends meet and survive during an extremely trying time in our history. So, interpretations of the New Deal. This is one of the more messy slides. Yes, I admit there are a few more like it, but you might want to refer back to this one as well, too. It will help you to study. All of the books on the right are pretty familiar ones, some of them older classics, some of them new, one of them very new, and all of them I own and have read. So much of what I say in this lecture, much of what you see on the PowerPoint screen, comes from these and other books I've read about this subject. So I know quite a bit about this subject. I'm sure you're not surprised, at least I hope not. So there's lots of disagreement about what we're supposed to think about the Great Depression, and particularly the New Deal, which was an unprecedented set of government programs and responses in government agencies, a new approach to government, which we've seen the beginnings of before, but we haven't seen it on this scale. More on that later on. So I've given you 3 quotes here from the books on the right. And the first one is an older and famous book about Franklin D. Roosevelt, the president, and his New Deal programs, that comes from that takes a favorable approach to Roosevelt and the New Deal. Basically gives it not more than a passing grade, an A. The middle quote, coming from a very recent book, takes sort of a more middle-of-the-road position. And not surprisingly then, the third quote here, coming from also a new book, takes a much more critical viewpoint of the Depression and the New Deal. So the first one thinks the New Deal was a success. Second one has mixed reviews. The third one is saying that it was largely a failure. So William Leuchtenberg, who is an admirer of the New Deal, or was, says the New Deal could advance impressive claims to being regarded as the savior of capitalism. Although it was the war which freed the government from the taboos of a balanced budget and revealed the potentialities of spending, it is conceivable that New Deal measures would have led the country into a new cycle of prosperity even if there had been no war. Marked gains had been made before the war spending had any appreciable effect. When recovery of the economy did come, it was much more soundly based because of the adoption of the New Deal program. I've forgotten how to read here in the last 2 minutes. So this is again a thumbs up for the New Deal. Stephen Knott in The Lost Soul of the American Presidency, which I have quoted in previous units, speaking of the Roosevelt administration, said, "Well, there was much to be praised in Roosevelt's presidency, including a compelling case that he saved capitalism and assembled a remarkable national security team to prosecute World War II. More on that later. There were troubling aspects to Roosevelt's presidency. These included his tendency to undermine existing institutions, in keeping with his former boss, Woodrow Wilson. The new president pursued an ambitious agenda designed to restore the confidence of the American public that was ill-housed, ill-clad, ill-nourished." As Roosevelt will later note, much of what Roosevelt did helped conserve American capitalism and is worthy of acclaim. but a constant theme of his presidency was that public opinion, not the Constitution, should dominate and guide the nation's public affairs. The founders believed that the essence of statesmanship was to rise above the conventional wisdom, to be better than popular opinion, and to resist that opinion at times. So Stephen Knott is saying that though it's true, or he believes it's true, that Roosevelt helped to save capitalism and put our economy sort of back on the road to health, that he had a dangerous tendency to think that the Constitution could and should be overruled by a president like himself going sort of around the Constitution, around the other institutions of government, and making a connection directly to the people and governing on that basis. Which, if you remember, and perhaps you do not, it's really what Woodrow Wilson was trying to do as well. Hence the reference to Wilson in that very quote. Moving on down to The Forgotten Man, the most recent book, at least that I know of, a single volume work on the Depression. The author takes issue with Roosevelt's leadership in the New Deal, at least in many ways, quoting, "The deepest problem was the intervention, the lack of faith in the marketplace. Government management of the late 1920s and 30s hurt the economy. Both Hoover and Roosevelt misstepped in a number of ways. Hoover ordered wages up when they wanted to go down. He allowed a disastrous tariff, Smoot-Hawley, to become law when he should have had the sense to block it. He raised taxes when neither citizens individually nor the economy as a whole could afford the change. Roosevelt's errors had a different quality but were equally devastating. He created regulatory, aid, and relief agencies based on the premise that recovery could be achieved only through large military-style effort. Some of these were useful, some were inspiring. Other new institutions, however, did damage. One of the most famous Roosevelt phrases, almost as famous as fear itself, was his boast that he would promulgate, quote, bold, persistent experimentation. But experimentation itself created fear. The trouble was not merely the new policies, but also the threat of additional unknown policies. Fear froze the economy, but that uncertainty itself might have cost was something the young experimenters, meaning the New Dealers, Roosevelt's guys, simply did not consider. So, again, a full range of viewpoints here on the Great Depression and the New Deal. By the numbers, the economics of the Depression, and the story they tell us. So first, the economy in the Depression, which takes us to Wall Street lays an egg, the great crash of 1929. On the opening slide, there's a famous cover from Variety magazine or newspaper that had that title on it. There were lots of creative titles for the Wall Street crash, the great crash of 1929, but that's the one that I think stands out the most. And boy, did Wall Street lay an egg. So here we're going to get into the causes of the Depression and the stock market crash. I'm kind of melding them together all in one, which you see sort of was causes of Great Depression, Great Crash and Depression on the left, and then through two quotes, try to kind of sort them out again a little bit, because the causes of the crash aren't necessarily the same as the causes of the Depression. Firstly, because the Great Crash itself, and this has been said over and over again by now, can be seen as both a symptom of an already existing problem in the economy, a recession that was already there, that almost everyone, I can't think of an historian or economist that doesn't believe that today, was already present in the 1920s before the stock market crash and depression. So if that's true, and it appears to have been true, then the stock market crash of 1929 was a result of that, was a consequence of that. But it also then was a symptom, or it is a symptom of that sort of already seen problem. But there's no doubt the stock market crash itself became a cause of a much greater economic problem, which we know as the Great Depression. So what was going on to make all this happen? Part of the problem, believe it or not, has to do with human psychology and the fact that Americans, investors, businessmen, average people, politicians were overly optimistic. Remember, we're at the end of the 1920s here, and we know this was a very sort of optimistic decade, at least for most Americans. And the headlines, for sure, were all about a new era. The new era meant, among other things, that the economy was going to continue to boom, the stock market would just go up and up and up, and this led to a wild optimism, even a mania, meaning sort of people being sort of, kind of crazy out of touch with what the economy is actually doing. They're believing what they want to believe. Another big issue was economic inequality. The 1920s saw inequality rise considerably from the previous 20 years of the Progressive Era and World War I. And most economists, I think, would tell you even now that economic inequality, when sort of too much money is in the hands of a few at the top and too little spread out, is generally unhealthy for an economy. One of the useful, I think, analogies is to think of the money supply, sort of the flow of money through an economy, through exchanges and buying and selling, is kind of like a circulatory system. So it's like blood, in the veins. And if there are places where there's too much sort of money clogged up, sort of in one spot, like being hoarded by a few corporations or a handful of people at the very, very top, then the circulatory system isn't working as well. So it's usually seen to be true that the economy is functioning well when the system is working, so money is constantly flowing around and it's not being hoarded and stuffed away and stopped from being sort of part of a larger productive economic system. There was certainly a problem already by the 1920s and for sure after the crash of overproduction and underconsumption. The best example of this is the automotive industry, and it's the one that's been studied by historians and economists ever since, for sure. But simply put, Ford and General Motors and others were selling more, producing more than they could sell. So cars and everything else is starting to pile up and collecting dust in warehouses because they've already saturated the market. You could think of it this way. We know that Ford and other American manufacturers are using techniques of scientific management and assembly line logic and technology to be able to roll out their product faster than ever before. So they've perfected producing products in a short amount of time, but it doesn't do them any good if nobody's buying them. And in a capitalist system, you're not supposed to have overproduction, underconsumption, and you usually don't. So something's wrong. Capitalist systems are quite good in theory and usually in practice at allocating resources effectively through the price mechanism and sort of supply and demand, so that this kind of thing doesn't happen. So overproduction, underconsumption in a capitalist system is a real sign of an unhealthy situation. Whereas easy credit is another issue here as well, and we'll talk about this one a little bit more later on. But access to credit, meaning low interest rates, can be a good thing, but it can also lead to what sometimes economists call moral hazard, which means it sort of tempts you to do unsafe, unhealthy things with your money. It certainly did here. The next two on our list there have question marks. Monetary policy too tight, failure to save the banks, question mark as well, because these have been suggested by two economists writing a famous book just after World War II, so long ago, but still after the Great Depression, saying that the reason that the country went into depression was not because of the stock market crash. They believe that could have been avoided. This is one of the most famous books on this subject ever, and by two noted, and one of them, considered one of the greatest economists in our history, saying that if the Federal Reserve, which was a fairly new organization, only about 20 years old at this point, had, instead of contracting monetary policy, instead of sort of trying to restrict the money supply, had they opened the spigots and made it sort of money flow more, they probably would have been able to avoid a depression, they being the Federal Reserve, the U.S. government. Failure to save the banks. There were no huge banks in those days, at least not of the size we have today. We have like 6 mega banks today. There's nothing like that. And so hundreds, eventually thousands of banks, local banks, collapsed in the Depression, and the Federal Reserve and the U.S. government didn't do anything to step in and try to save them. Most of that happening in like 1931. And so the book in question here, which is a book called The History of Monetary Policy in the U.S., which sounds really boring. I've actually never read it, to be honest with you, but I've read a lot about it. So the claim is that had the Federal Reserve done one or both of those things, that it's likely that the Depression wouldn't have happened. Maybe a recession, something lighter than a full-on depression, might have taken place, but certainly not the catastrophe of a decade that now virtually defines the 1930s for us. From a book called An Empire of Wealth, An Economic History of the U.S., talking about the stock market crash and sort of how it came about, is the following, I think, very telling quote. By the spring of 1929, the economy had cooled noticeably. So the economy had been going up. By the last few years of the 1920s, the stock market was in a huge bull market. Stocks were going up at an unprecedented pace. Everyone was getting excited about it. But he's saying that by the spring of 1929, things had cooled. Wall Street, however, appeared not to notice. The Dow Jones Industrial Average continued to rise while the economy began to move into recession. But the wider market, including thousands of secondary stocks and those not included in the most widely watched averages, like the Dow Jones, had the Dow Jones Industrials like a dozen corporations that they average out, and that's all it is. It can be useful, but it can be misleading, as you see here. So those averages had begun to decline, the less watched ones, with the economy. Such is the power of human psychology, back to psychology again, that neither the market nor the public noticed, and all attention was focused on the most widely held stocks. The market was caught up in a bubble, and bubbles are always recognized by the public only in retrospect. By the summer of 1929, Wall Street and its millions of customers were deeply out of touch with the underlying economy, visions of riches dancing in their heads, and even knowledgeable people were caught up in the frenzy. That's very well summed up and said by the author there. So we'll get back to that question in the next slide, but his pithy quote would be useful to go back to if you don't already understand that, go back and study that again. So what then caused the Depression itself? As one of the authors quoted already about interpretation of the Depression said, part of the trouble was indeed the Great Crash. There were monetary and credit challenges at the young Federal Reserve, also already mentioned briefly, and certainly at the banks. Deflation, not inflation, was a big problem, both early and also later. The loss of international trade played a huge role. We'll get back to that issue as well in a later slide. Part of the problem was the challenge of the transition to industrialization from agriculture, sort of the continuing move into the industrial revolution, greater and greater as time goes on. Part was just freakish weather, floods, and the uncanny Dust Bowl migrations, or Dust Bowl issue that led to migrations, seemed to validate the sense of apocalypse. But the biggest problem was the intervention, the lack of faith in the marketplace. So according to the author, the scholar here, the biggest problem was not the ones that she first mentions, those are issues, but the biggest issue in her estimation is that the government tried to do too much and didn't place enough faith in the marketplace sort of rebounding on its own in kind of a laissez-faire, hands-off way. So back to psychology yet again, psychology of a bubble. What is a bubble? This is a term that actually is used widely in economics today. So a bubble is an unsustainable price. It's a commodity with an unsustainable price that's thought to be real. So if something, some sort of asset people think is valuable, but it's not as valuable as they think. It's a bubble, and so like a bubble that you blow a bubble, right? What are the properties of a bubble? Well, they sometimes expand and expand and fly through the air, but they always pop. So a bubble economy, a bubble asset situation, whether it's stocks or real estate, whatever else it may be, means that the prices are misleadingly high. They're high, and people think that this shows that things are going to continue to get better or stay where they are, but it's not real. It's not sustainable. How do you spot a bubble? Well, it's quite hard to do, actually. So I'm not saying that it's easier to do, but it's not impossible. In all these types of economic downturns in history, there's been a lot. There are people, usually a small number, usually experts, not always, who sort of see a bubble. Sometimes maybe they're just guessing and they get lucky. But sometimes I think prescient individuals can pick up on some of the signs, as hard as they are to see. One of the reasons they're hard to see is the psychology. People believe what they want to believe, see what they want to see. This is I think, a problem inherent to human psychology and human nature. Not that we can't overcome it or reduce it greatly, but it's always sort of threatening to be there. So only those that can sort of get out from under sort of this, especially when it becomes social, when everyone's saying this is fantastic, this economy, this stock market is, you just got to invest, just find some money, throw it in there, and you'll double your profits overnight. You can't lose, and that's the kind of thing you start to hear in bubble situations, whether it be 1929 or 2007, before the housing bubble again burst. You had people saying those kind of things. The market will never stop. This will go on forever. So you can sort of spot them, bubbles, partly by this kind of mentality that you start to hear. This is going to rise forever. And I've had some friends in previous economic downturns that had this kind of scary look on their face when they talked about it, and got this kind of glazed over look in their eyes, kind of like they were being led around by some sort of cult leader or something, and they've been brainwashed. It's actually kind of scary. If I didn't necessarily, at the time, I was much younger when this experience happened to me, so I didn't necessarily know at the time, but in retrospect I can see, wow, I knew the way they were talking and the way they were sort of looking at everyone in the room and me was strange, but I didn't realize until later that this was the bubble mentality. At least that was my interpretation. Another sign that there's trouble looming with regard to asset prices being unsustainably high in a bubble situation is that there's huge leverage, which means that particularly institutions, corporations, banks, mortgage lenders, if it's housing, they're invested in the markets, whatever the assets are that are they're unrealistically high. They're borrowing money like crazy to invest. So it's like an addiction. I'm so convinced that this is a good time to buy this or that asset or this or that stock in this case, that I'm not just going to spend the money I have. I'm going to borrow money and buy more. And so and individuals do it as well. So people at the individual level drain their bank account, savings account to buy more stocks, or buy a second and third home. They raid their children's college fund. They've been saving for years to save up for their kids to go to college, and they raid that, assuming, being certain that they're going to double, triple their money, and not even thinking that it's possible they can lose it. Well, of course you can lose. One simple cliche to keep in mind in understanding this kind of situation is the old saying, if it sounds too good to be true, it is. And so keeping your head about you in these kind of this kind of atmosphere is very difficult. And as I said, there are a few people that do. It's not always clear why and how some people do and some people don't. It's not always about intelligence, though it might sometimes have something to do with it. So, and when things go from mania to panic, that's when things start to collapse. So you can kind of see the trajectory of the Great Crash of 1929. But this, honestly, is the trajectory for almost all financial crashes throughout history, going back 250 years. The tulip bubble in Holland. Yes, tulips were overpriced in a bubble situation in Holland. I'm not kidding. It was a major economic disaster of the time. But that was in the 18th century. And almost all, if not all, financial downturns, financial crashes look like this. Confidence, which is perfectly healthy. Then overconfidence, at least if the underlying asset or assets aren't as valuable as people think they are. We're not talking about a situation where if this gold line you see going up, which means is the share price, the stock prices are going up, and the economy, the products, the companies, the corporations underneath them are in a healthy state and getting more healthy and more profitable, then it's not a bubble because it's sustainable. It's only when confidence gets out in front of, and too far out in front of, the reality of the underlying economic situation that it becomes a bubble. So overconfidence means now you're confident when you shouldn't be, or at least shouldn't be that confident. The president of the New York Stock Exchange in 1929 at one point said, "The millennium's arrived," which I always love. It's not talking about millennials. It's talking about religion. The millennium comes up in traditional Christianity and even current Christianity a lot. It's usually a reference to the second coming of Jesus. I wish he would have just said that instead. I wouldn't have to explain it as much. But he's saying that this stock market rise is as good as the second coming of Jesus. Now, I'm sure he didn't really mean that to be literally true, but the fact that the president of the stock exchange said that is quite telling. The next phase, that's sometimes labeled this way by scholars today, is mania, a manic phase, and where overconfidence goes to sort of irrationality, and it's at this point usually, and you saw this in 1929 as well, that sort of greed starts to take hold, and a get-rich-quick mentality sort of becomes a part of this. It's also the phase usually where there's a great deal of swindling and fraudulent activity because people see the chance to make a killing here. The very fact, however, that there's a get-rich-quick mentality does imply, of course, that there are at least some, those that feel like we need to get rich quick, that realize that this isn't going to go on forever. So they're already thinking, yeah, I got to get in here while the getting is good before this whole bubble, pops. So there are those. When the market got to incredible heights by the summer of 1929, this is when the public and investors and even experts were completely out of touch. The line for the where the real economy was is not even close to the upward arrow there. If you go back to the bottom left where the gold arrow starts and sort of move your finger right across the screen, parallel to the bottom of your screen, and actually start going down a little bit until you get to the orange in the bottom right, that's basically what the economy was doing. So the stock market, the share prices should have looked like that if it was going to be in step with the economy. So the economy was actually getting slightly worse, already in recession, probably 1928, and yet the stock market is going up, 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 up. So it brings us to something simple and complicated at one and the same time. The question as to what is it that causes stock prices to go up or down? Well, we're going to just keep to the simple part of it, and it is in some ways this simple, and that is that stock prices go up based on basic supply and demand, just fundamental economics. So when everybody wants to buy a stock in a given company, wants to buy stocks in a given industry, whatever the company, and there's a huge demand for it, the companies, the firms, corporations that are selling the stock, or individuals that already own it, can sell it for much higher. And the more demand there is, the more the prices rise. When demand starts to hollow out, when people start to lose faith in the stock or the company or the industry, then there's decreasing demand, eventually little demand, maybe no demand, and then the share prices will go down. So I think you already see here that it in a sense it has nothing to do with reality. If people think that the prices, if they think that the assets are valuable, the prices are going to go up because the demand to buy is there, and people are buying, and the prices just keep going up. So it's only when people do start to finally doubt and think, I don't think this is sustainable, and they kind of figure out that it's a bubble. Oftentimes too late for most people, that things start to change, and then the prices go back down, which is where they should have been in the first place. But they shouldn't have had to fall this far, because they should have never gotten that high in the first place. So eventually, the dizzying heights of the assets in stocks, again, other times it's tulips or home mortgages. The dizzying heights cause people to say, wait a minute, this is now so high, it doesn't seem realistic any longer. Maybe something has to give, as Alexander Noyes, a financial analyst on Wall Street, said at the time. And so often it's a handful of experts that first start to think, you know what, I'm going to start selling some of this. I don't think it looks good that this can just keep going up and up and up forever. Though not all experts, again, maybe not most, even think that. At the top of the screen, you see a famous quote from a very distinguished economics professor at Yale University, very well connected, named Irving Fisher, who said just days, this is just days before the stock market crash in 1929, that stock prices have reached what looks like a permanently high plateau. Now, at least he said plateau, because he's not saying, at least in that sentence, that prices are going to keep going permanently higher, but he is saying they're not going to go any lower. Plateau means they've sort of leveled off, but they're going to stay at that high level. They're not going to go back down. But that's still quite a confident to incredibly overconfident statement coming from someone who should know better, a Yale econ professor. So it's only a few at first that seem to realize that something does have to give. But then once experts and big corporations who have large stock holdings, and banks who have them, and had them in the 1920s as well, when they start selling off, then average investors, people that are just doing it as an investment personally, sometimes rich, sometimes middle class, they start to freak out. If J.P. Morgan and Company, you see, starts selling off their stock for this and for that in huge chunks, and you're just an average guy who invests, for fun, or to try to, make a buck here or there without really knowing too much about the market, you're an amateur, you're likely to freak out. J.P. Morgan must know something I don't. I better sell. So this is when doubt and inside information lead to panic and stark raving fear. And people are rushing to sell their assets, in this case, again, stock. So the great crash of 1929 happened in late October of that year. 2 days, Black Thursday and the following Tuesday, known as Black Tuesday, 2 of the worst single days in stock market history. And then over about a week, really a 2-week period, you saw the stock market just bottom out. And basically all the gains that had been made over the previous number of years just wiped out, gone. Which means you could have started just for the first day of the crash. I mean, there's hard to know what the literal first day is of it. But you could start, say, with, let's say you had $1 million worth of stock in your portfolio. And a week later, 2 weeks later, it might be worth $10,000. So wait a minute, where did that money go? Money just can't disappear. Yes, it can. And it just has. So you've gone from $1 million to $10,000 in your stock portfolio. And just to show us how this panic sort of was made even worse. People have totally lost confidence. Now they're not only, they're not overconfident, they are terrified. And many of the people that had lots of stock, corporations and banks that had lots of stock, were leveraged to the hilt, which means that they had bought a lot of their stock on credit, on margin, as they call it. And so let's say you're a rich, I don't know, investment banker, and maybe not your bank, but you, I mean, they do it too, but you on your own, from your own salary, your own savings, you bought $1 million worth of stock just recently. And you bought it on credit. So you went to a brokerage house, brokerage firm, or a bank, and you put down $100,000 to buy $1 million worth of stock. So just like you can buy a car, right, or a house by putting a down payment and then making payments, that's what you're doing with stock, buying it on margin. Well, so you owed the bank or the financial institution, whatever it was, $900,000. You still owe them that. And the stock market crash happens, and your $1 million worth of stock goes down to $10,000. You only have $10,000 in stock value, and yet you owe the bank $900,000. What do? Well, you panic. There was a famous series of suicides on Wall Street, New York City. Whether or not it was a wave of suicides, sort of beyond the norm, is sometimes open to question, is questioned. But it does appear that there were some, certainly, that had to do with people losing their entire fortune and thinking my life is over and I'm checking out, and did. But one of the things that happens here, which will help us to connect how a crisis on Wall Street, right, stock market crash, has anything to do with the wider economy. Today they say, how does Wall Street, right, connect to Main Street? Main Street means like businesses in your hometown, and insurance companies in your hometown, and stores and supermarkets, and whatever else. So we see the first example of this. Let's say you're that guy who just lost $1 million worth of stock through this crash, and you owe $900,000 to the brokerage, who, by the way, are calling you from the moment this starts, and they're saying we want more collateral put up. So they already want their money back. It's not just like, well, I'm okay. I've got a few months before I'm supposed to make my next payment anyway. No. They're now speeding up the payments and saying, sorry, that those are the terms of the deal, and you knew it going in. If this kind of thing happens, we're on you right away. So it is time to be concerned. But you wouldn't have bought $1 million of the stock with $100,000 down unless you were a pretty rich person in the first place. So you probably have other investments in other assets. Let's say you own real estate. So what do you start doing? Well, you start liquidating your real estate, selling your land, and taking the money from that to pay back your creditors on Wall Street. Pay back the banks, brokerage houses that lent you the money. So what does that tell us? Well, it tells us then that the Wall Street stock market crash then could and did cause prices of other assets outside of Wall Street to fall as well. Because if rich person after rich person after rich person starts selling off their real estate quickly, then that ends up being a lowering of demand in real estate. And so real estate prices go down. So anybody that starts selling off another asset to be able to pay back their financial losses, if enough people are doing that with regard to that asset, that loses its value as well. Also, compounding the problem here in 1929 was the fact that early on in the crisis, about a weekend or so, the U.S. government tried to get the richest bankers, J.P. Morgan and Company, and others to kind of rally and together buy huge chunks of stock to prop up the market, which was designed to restore confidence, one, so that if average people saw, oh, J.P. Morgan is buying, then I guess I don't need to sell mine off so quickly. Then they would too. And second, that if big banks buy large chunks of stock, that's a big uptick in demand itself, and so it could conceivably show itself on the market itself as a rise in stock prices, which actually did happen for a short time. The markets did kind of rebound slightly, but then even the big corporations and the big banks that had cooperated for a few days on this, even they wanted no part of it, and so it ended up being actually worse, because once the public and the investor class, or average people that invest, see, wait a minute, the banks don't even want any part of this attempt to get this going in the other direction again. They bailed out of it. Right now, people start freaking out more. To make things even worse than that, in those days, the technology that allowed you to find out how your stock was doing, you've probably seen this in movies before, was a ticker tape. And you could sort of look at the ticker tape going across every, I don't know how many hours, or every hour, whatever it was. But when trading was clogged with as many transactions as there are here, as everyone's freaking out to try to sell as fast as they can, the ticker tape machine slowed down. And so this in itself, I think, tempted people to sell immediately because of a fear that if normally, today we have almost instant access to where the stock price is. So you wouldn't, okay, my stock's going down, but I'll wait 5 minutes, I'll wait an hour, 15 minutes, and sort of check it again. And so you have a number of points where you can sort of keep looking at it, and once you've sort of established, okay, this doesn't look good, I'm selling. But here you don't have that luxury. It's like I haven't gotten a report for like the last 3 hours. This thing is jammed up. By the time I get the next one, I might find that my stock has lost all its value. I got to sell now and at least salvage something. It's already dropped by 25%. But if I wait for the next piece of news to come out on this, it might be down to nothing. So I'm selling now. So there are many other things we could talk about that all led in the direction of panic and just a frenzy of selling. And a good question students will sometimes ask is, well, if everyone is selling, then who the heck is buying? That's a good question. The answer was sometimes nobody. There were some firms that were selling their stock for $1 a share, and they weren't getting takers. So people are so they've been so chastened by this that they're afraid to even put down $1 for a share. But you can probably guess the other answer, and that is if you look at the little squiggly arrow that's moving down, look where the arrow actually is, the bottom point of the arrow. Okay, so let's say stocks are at that, whatever that price is there. Who would want to buy when stocks get that low, or even a little higher, but still low? Well, a rich guy that sees an opportunity and says, you know what, this is smart. This is a great time to buy because I'll just snatch this up at rock bottom prices, and I'm rich enough where I can afford to hold on to it until it starts to go back up to a normal or high level again, and I'll make a fortune doing so. And so this is how and where you see and get buyers. The problem was that these guys who think they're so smart, who hadn't been, if they hadn't already been crushed, but in the first phases of the stock market crash, and many rich people hadn't been crushed by this. Some had, some hadn't. But the joke was on them in the end, because over the next 9 or 10 years, rest of the next decade, there were no stock market crashes. But as John Kenneth Galbraith in his classic book called The Great Crash said, one of America's greatest economists, deceased now, but in his classic work on this, he said, over the next 10 years, the stock market just very, very gradually and slowly declined. Just sort of a very, very slight incline, right? Not a steep drop in any month or year, but just gradual, but it was consistent. I mean, there were a few exceptions, but overall, right, the stock is going downhill, but just a little bit at a time. So if you even held on to it for the full 10 years, 10 years later, you'd have stock that was worth not a lot less, but still less than it was when you bought it, thinking you were being so smart because it's dirt cheap, and I'll just wait for it to come back. It still doesn't come back even 10 years later, and it's worth slightly less. So the crash from a graph's perspective. Can a graph have a perspective? Not so sure, but it sort of looks like this. So the Great Crash is in the middle there, pink, whatever that color is section, and you can see right a rather precipitous drop, and you can also then see the rise, at least from the previous year, to get to the high point before things started to. There were some warnings, right? I mean, if you look at the peak of the purple area there, just around September of 1929, right? That's a fairly significant series of drops in there, and yet it did go back up again, and then kept crashing down with a rebound, and then another crash again, before prices started to come back up, but never reached anything close to the heights they had been before, at least by the next year. What's in a graph? We just saw one. 3 more here. What do the numbers tell us? So now we're looking at not the stock market crash itself, but its effects and all the ways in which the economy was sort of moving into depression or out of depression, depending on how you look at it, which also then gets us to sort of an early appraisal. Again, we'll get in more detail later on the New Deal, the government response, and the Hoover administrations even before that. So U.S. production, right, manufactured goods, you can look at the graph there. Farm prices, you can look at it here. Per capita GDP, per capita means, GDP means gross domestic product, so the total of all the value of goods and services in the country. Per capita means sort of the per person, per capita. So if you take what the GDP is, divide by the number of working people, that's your per capita GDP. And so that's going up after the sort of the low point in that about 1932. And the farm prices appear to have bottomed out in 1933 and have come back up. And U.S. manufacturing or production bottoms out in like 32. Right, and then sort of rather jaggedly starts to rise from there. So from those 3 sort of markers, benchmarks, it does appear that during the time that, and that's the New Deal, by the way, 1933 and on, it does look like the economy was sort of rebounding, moving back up, not to its pre-crash levels, but nonetheless moving in an upward direction. That doesn't tell the whole story, however. A lot of things depend on which statistics, which information you look at. So part of why historians disagree about whether the New Deal was a success, how the country got out of depression, and so forth. There were a number of vicious economic spirals, downward spirals took place that helped lead to this depression. So again, we're now kind of moving from Wall Street to Main Street. Quoting Wilfred Maclay, his book Land of Hope, which I've quoted before in other units, he says, once the downward spiral of the economy gathered momentum, it seemed unstoppable, and its effects ramified out in every direction. Automobile output fell from 4.5 million units in 1929 to 1.1 million units in 1932, and Ford laid off 75,000 workers with similar ripple effects on auto-related industries. Right, that's a lot of jobs cut, a lot of production cut by right, it goes from like 4.5 million to 1.1, and related industries. I mean, think of how many even today, especially today, right? Other types of businesses are related to automobiles. What's an automobile made out of? Glass and rubber and steel and oil, and so those are the things that are likely to be taking a hit as well. So I'm not going to read this whole downward spiral to you. I'm going to simplify it a bit, but it would behoove you to go back and look at this. So we'll simplify this, and that's really what Maclay was saying in the quote as well. So if people have lost a ton of money on Wall Street, and it starts to spread into Main Street as well, and so the buying power is down, demand is down. So individuals don't have enough money to go out and buy as many products as they used to. And so the manufacturers see this in their receipts, and so we got to cut production because we're not going to. There's no point in making stuff that's not going to sell. So we're going to produce half as much this year as we did last year, or at least it appears that way. So what are they going to do? They're going to have to slash workers. If they're cutting their output by half, then they're likely to be cutting their labor force by like half. And so they lay off like half their workers. And so now there's even less buying power in the economy because workers are also consumers, and they don't have, let's say you live a family of 6 people living together, grandpa, 3 generations, and so there's, 4 people in the house that work, and one by one they start getting laid off. And so there's less and less buying power in the house. And so now, right, after that sort of round of downward spiral, now there's even less buying power. And so the corporations that produce widgets and everything else, they decide we're cutting back. We have to cut back production again, so we're cutting the labor force again. More layoffs, which means less buying power. And down and around and down it goes. This is the classic deflationary spiral in depressions, and there are others as well, but that's the classic one, and that's the one that's really hard to get out of, but it's the crucial one to get out of if you can. The banking system collapsed in what's sort of like a downward spiral, not exactly that pattern, but Maclay again says more than 1,300 banks closed in 1930, 3,700 more in 1931 and 32, depressing both consumption and investment in one stroke. People who had scrimped and saved for years to buy a house or send their kids to college saw their hopes destroyed in the blink of an eye. So you see these lines in these photographs here outside of banks. These were classic bank runs, as they were known. So what often happened was banks sometimes invested heavily in stock market transactions as well. And so when the stock market crashed, they were either out of business outright or teetering on the brink of insolvency. So because of their own dumb investments by buying in a bubble market, they put themselves in jeopardy as a bank, and they put everybody's money in the bank that's in the bank in jeopardy. Your checking account, your savings account is now in jeopardy of disappearing, because in those days there was no Federal Deposit Insurance Corporation, or FDIC, which you see at the bank every time you go in now. And so if the bank goes out of business and you have $25,000 in your savings account, it's gone, done, never coming back. Now the government has a fund that guarantees that. And take a wild guess when that fund was put in place and by whom. It happened through the New Deal during the Great Depression by the Roosevelt administration to kind of keep this kind of thing from happening. Because, so let's say the bank on the left, American Union Bank there. Let's say you come home from work one day, and your husband or wife is there waiting for you at home, and they say, honey, I just talked to our next door neighbors, and their bank, there's 2 banks in your town, American Union Bank and say National Union Bank, just to make up a title. So they their bank, American Union, collapsed today, and they lost $25,000 in their savings. Thank God we have our money in National Union Bank, right? But that's not going to give you much comfort. A little bit, because where are you likely to be the next morning at like 9 o'clock when the bank opens? Well, over there on the right at National Union Bank. I don't know what the name of that bank is. I'm making this up, but you are going to be in line there. In fact, if you get there at 9 when the bank opens, you probably won't even be right there. You'll be down around the corner, a few blocks down, because people will have gotten there at like 3, 4, 5 in the morning to be the first or fifth person to get in that bank. Because what they're doing, of course, is withdrawing their money before the bank collapses. And if you get there, if you're the next person in line, right, you're the next one ready to go in the door once they let you in, but someone come out and say, sorry, the bank has gone bankrupt, you're done. You got there a few minutes too late. If you'd been one spot ahead in line, you would have made it. So people are desperate to get their money out before that happens. So think about this for a second. This is a terrible situation because you can certainly understand why people want to get in that bank and take all their money out. It's not an irrational thing to do at all under these circumstances, and yet it's possible. And in some of these banks' cases, it was for sure. I don't know if we can know which ones it was, but for sure in some of them, the point is that the bank was in trouble already, but it was sort of propping itself up, and it may have survived. But what actually sent it crashing down into the canyon below in total bankruptcy and failure was the fact that everyone comes in and takes their money out the same day. That was the final straw. Had very few people come in to do that, or nobody, the bank may have stayed alive. So this ended up being a terrible situation as well. Again, because it's not irrational from the average, person's perspective. The customer they know they're going to lose all their money if they don't get the money out. But yet, by everybody doing that, it made more banks collapse than otherwise would have. More than 1,300 in 1930 and 3,700 more in the next 2 years. That is a disaster.